Verizon stock is down more than 4% today after reporting earnings. Let's take a look at why it's down and whether it's a good stock to buy today. If you like this content and want to see more of it, check out smartstocks.ca and also be sure to subscribe for more of these types of videos. So let's start with Verizon's press release. It said it reported strong third quarter results. It's on track to meet its 2024 financial guidance. That's always a good sign that it's on track. There's no surprises along the way. Its overall growth rate, not all that impressive. 2.7% increase in wireless service revenue. So that's its main item that makes up its revenue. But that's really what investors have come to expect from the company and other telecom providers as well this year. If we look at Verizon's guidance, it's expecting 2% to 3.5% growth in wireless service revenue. So really within that range, not really any surprises with that. So it's on track for that. So why is it down? So let's go over to CNBC, which always compares against analyst forecasts to see why it might be down. And a big reason why it expects CapEx to rise next year, capital spending. So as it's building out its network, it's going to have to spend more money to do so. And that can be a bit of a concern because higher than expected spending obviously could weigh down on its margins and its profits. So overall, it's not a terribly big increase, however. So forecast capital spending for 2025 is between $17.5 billion and $18.5 billion. So the midpoint, which would be $18 billion, is above estimates of $17.57 billion. So we're talking about a difference of less than $500 million in capital spending. And when you're talking about $18 billion in spending, that's not a significant increase in terms of percentage. But unfortunately, with stocks, any sort of bad news or perceived bad news can weigh down on a stock. Now, another reason why investors might be down on Verizon today is its Frontier deal may be a bit uncertain because Verizon agreed to buy it for $20 billion, but apparently Frontier's shareholders are concerned that it's not enough. So it might cost a bit more. The deal might not go through. So that's another reason why Verizon stock may be struggling today. Now, further down, we can see that Verizon's revenue, $33.3 billion, came in below expectations, $33.4 billion. So again, just a razor thin miss there, not really anything huge. Adjusted profit per share of 1.19 was above estimates by 1 cent. So overall, nothing really there that's striking as a huge reason why Verizon should be down between its Frontier deal possibly falling through, which isn't a certainty, and an increase in CapEx but by about 0.5 billion higher than analyst estimates. There's not really a ton of bad news in there. But overall, it's still down 4% today. And if we look at a year-to-date basis, Verizon's been doing fairly well, up around 10.5%. Not as good as the S&P, but it's been doing fairly well nonetheless. It's been rising recently since rate cuts took place in September. And so what typically has happened is a lot of investors have moved from bonds and into dividend-paying stocks, especially high-yielding ones like Verizon. Because if we look at the 5-year trend, Verizon stock is down more than 30%. But the big decline started to happen around 2022 when rates were coming down. So when rates were going up. So with rates going up, investors have a lot more opportunities to generate high returns on investments through bonds and through other assets. And so dividend stocks become less attractive by comparison. And also telecom companies like Verizon that are spending a lot on capital expenditures, that have a lot of debt, those costs go up. So they become less attractive. And so that's why the stock's been down since rates have been increasing. But now with rate cuts taking place and potentially more rate cuts coming in the months ahead, that trend could start to reverse. And it's already started to this year because we can see in September, it got a big boost around the time when interest rates were coming down or expected to come down. And so it's been starting to rally on that. So that's a potential opportunity for the stock to to build on those gains into next year. Even though it's dipped right now based on this earnings report, there's nothing really terribly concerning enough to suggest that, okay, Verizon's in big trouble or that's somehow become a worse buy based on its latest earnings numbers. If you look at its fundamentals, the stock is trading at a forward price earnings ratio of just 9. So that's 9 times next year's earnings. So not terribly expensive. 1.4 times sales, book value at a multiple just under 2. So nothing terribly expensive here. If we look at its overall yield at 6.2%, so this is a fairly high payout. The S&P 500 average is around 1.3%, so you're getting much more in dividend income with Verizon than you would be with the average stock. So if you're a long-term investor, if you're considering on holding for multiple years at least, I think Verizon could be an underrated stock to buy just because as interest rates continue to come down next year or even perhaps later this year, that stock could start to rally again. So not only do you have the potential to earn a lot of dividend income for Verizon, but the stock could be due for a bit of a rally just because it has been struggling due to high interest rates. And as those come down more, the stock could be a much better buy because now people could be pivoting back into high yielding dividend stocks like Verizon. And as that happens, that yield is going to start to come down. The share price is going to go up. And so by buying it now, you can benefit from both those trends, locking in a high yield right now and also benefiting from the potential for the stock to rise in the near future. So I think Verizon's still a good buy. Nothing in the earnings report that was really all that concerning that should make you worried about the stock in either the short term or the long term.